So we are on week 3, and we're doing great so far. Everybody's homework's looking good. Discussion threads are looking good. So with week 3, we're going to be talking about property, plant, and assets, as well as intangible assets. And what we're going to be dealing with is depreciation and amortization. Depreciation is involved with equipment and property, and amortization is dealt with intangible assets. And I'll explain that in just a minute. What you're going to be looking at in week 3 is different methods of depreciation. If you remember in your introductory accounting classes, you probably dealt with straight line depreciation. And if we just go back a little bit and talk about what depreciation is, it's to show what the book value is on the balance sheet in regards to when I'm going to say equipment, what equipment is worth on December 31st or whatever date the balance sheet is distributed. So if you bought equipment 2 years ago for $50,000, that equipment over the last couple of years has probably declined in value, similar to when you purchase a car or anything else that might have use over the number of years. The value is going to decline. So we need to reflect that $50,000 of equipment that we purchased is declined in value, and depreciation is the way that we go about that. So there are a few different methods. There are GAAP methods, as well as you might use one for GAAP or one for the books, and you might use another method or for tax purposes. You're going to be learning the GAAP methods, and so you're going to be looking at the straight line method, which you're probably all familiar with, the double declining method, and the units of production, and I was trying to remember one of the sum of the years digits method. So that's going to be your focus. The other thing you're going to maybe touch upon, well, not maybe, you will be dealing with, is amortization. And amortization is the same way as saying depreciation. However, we use amortization in regards to intangible assets. An example of an intangible asset is something that's not tangible, something we can't touch and feel, like the equipment. An example of that would be like a trademark, a copyright. And so on your balance sheet, you might have a trademark or a copyright, and again, you're showing what that value is over a course of the years, and the amortization methods does reflect that. So on that note, that's what week 3 is going to be about. If you have any questions and concerns, as usual, contact me. I'll work with you, and have a good rest of the week.